Mike and Tom are registered with Stewart Partners Global Advisory LLC.
Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom. All right, welcome back to another edition of Common Sense Finance. This is Mike Wiginton. I'm Tom Farrell. You know, Mike, it seems like we kind of get on a certain theme and we kind of stick with it a while because, you know, I don't think one podcast can do some things justice. We kind of have to roll along and do a handful of those. But what we're about to talk about is one of those things that I think we're going to be talking about for a while. Basically, you know, we use the past to try to help predict what's going to happen in the future in economics and finance. But the future may look a lot different from maybe what we've dealt with in the past 20 or 30 years. What do you say about that?
Yeah, absolutely. And I think that is a theme. My opinion, this is going to be a theme that we're dealing with. And we're talking about a number with our clients, a number of those issues right now. And we've actually done a podcast on this. So take this, for example. It wasn't that long ago that if you had $1 million in a savings account of some sort, an investment account in your 401k, that was it. You were set for retirement.
Yep.
Okay, you were set for retirement. Good to go.
Even you would say, yeah, you can retire.
Maybe not.
Probably not.
Maybe. I'm not saying that's the most healthy thing for your mental state of mind.
I know.
But I'm saying from a financial perspective, you were set up. You were in good shape.
Right.
Have you checked the national average on CD rates lately?
Yes, the national average, and Matt's going to put this up on the screen for you, is 18 basis points.
So what's 18 basis points on $1 million?
$1 million, that would be $1,800.
$1,800 in a year.
1 year.
In a year.
In a month, what is that, $150
That's smoking,
a month?
isn't it? If
you look at a monthly income off of that, that's $125 a month.
So
that's not a lot.
You know, so right off the bat, I mean, that's an obvious. Where are you going to take your monies and get a return? This is another thing that we've been on lately. You've been blocked in to a corner, shoved into a corner. Your options are very limited. Anything that bears an interest rate, corporate bonds, municipal bonds, anything that bears an interest rates are extremely low. Okay, so when you sit there and we talk about asset allocation, how much is going to be in stocks, how much is going to be in bonds, how much is going to be in cash, you know, your traditional asset allocation, you've got to really look at the allocation to fixed income. I can't afford that. I won't make it. Mm-hmm. Okay, it's required people to start looking at alternative assets, active investments. We did a podcast on active investments. Okay, and do I need to own an apartment building? Do I need to buy a duplex? You know, so that's one way, and of course that's been here for a little while.
Yes.
But that leads me to my next thought is that, and we talk about regime changes, and when we say that, we simply mean it could be a policy, it could be a thing like an interest rate level or or an interest rate direction, interest rates going up, interest rates going down. Or inflationary period that happens during a significant number of years, and let's just say over a 10-year, a decade, and that theme is something that kind of affected in a big way rates of returns. You think about the 90s and then the technology revolution happened in the 90s, and look at the stock market returns then. But that was a regime. Then you went on into the 2000s, and that regime went away, and there are other things that were that were directing rates of return more. Okay, so here's a regime for you. Matt's going to show a 40-year chart of interest rates here. Okay, a 40-year chart of interest rates. Woo! In my opinion, I think it's a real threat that's over. That we're going to be in a period of increasing inflation that I feel like we've already started. A lot of people disagree with that now. Okay, and we're not going to get into that today. You do a whole other podcast on wage inflation.
we will.
Okay, so what's going to happen with inflation? And the customary way that you fight inflation is through increasing interest rates. Okay, but the thing is that if you're increasing interest rates, so good, we've got increase in interest rates, but that's because it's an inflationary environment. That's a death knell to fixed income.
Yeah.
A death knell to fixed income. So I think that option that's a whole new world that we're in, and I think it's going to lead to increased volatility, which will be another change.
Yeah.
2008, 2009, the people in the back halls of finance called that move in 2008 and 2009, the great financial crisis, they call that a 3 standard deviation move, which means it's rare. It doesn't happen. They would say, oh, it's once in a lifetime.
Right.
I don't know that, not that we're going to have 50% market moves on a regular basis, but I think that what they normally saw is happening very infrequently. I think we get to a situation where perhaps that happens more frequently than it did in the past.
Right.
So, several reasons I think that our the near future in terms of finance and economics is going to look a lot different than the past.
Well, that does it for part 1. We'll be back with part 2 later. Thank you.